I've been working on a tool that I'm finally ready to share, and hopefully, this helps you make some decisions and manage your taxes wisely. When you're retired, you have more control over your income than you did in your working years. And so the question becomes, how much income should I take this year? And one way to look at that question is with a tax graph like this. And you'll find a link to this tool in the description below. And this can all seem really complicated, but we're going to walk through exactly how it works, what some of the pitfalls are, and how you can verify the results and actually understand your taxes so that you're more confident about what you can do. This is really designed to help you figure out what time it is without you necessarily having to understand exactly how the watch is made and how all of these complicated calculations work. That said, you still do need to double check the time, but this should simplify things. Some basic questions that this can help you answer are, number one, I need some extra money this year for spending or an emergency. So should I sell some stocks at a gain? Should I spend from my cash reserve? Or should I take that money out of my pre-tax IRA? Number two, maybe you want to know if you should convert money to Roth this year and pay some taxes now, and maybe how much exactly should you convert? A third example is, in general, you just want to know how can you pay taxes at relatively low rates? What are some opportunities that you might be able to take advantage of? By the way, I'm Justin Pritchard, and I help people plan for retirement and invest for the future. So besides the link to this tool, you're also going to find some great resources in the description below for some general retirement planning. Let's talk about tax graphs. So a tax graph can tell you how much you really pay in taxes as you increase your taxable income. And that can be confusing because you might think you're in a low tax bracket, but things like the so-called Social Security tax torpedo can have you paying surprisingly high rates, possibly in the ballpark of 49% on income that you take. Now, I don't love how the so-called tax torpedo gets sensationalized. The name itself is even a little bit dramatic, but it's important to at least be aware of this. And briefly, the way it works is that at certain income levels, when you take $1 out of your pre-tax IRA, for example, you'd pay income tax on that dollar, and it also causes 85 cents of your otherwise tax-free Social Security income to be taxed. So that income goes from tax-free to taxed, resulting in what ends up being a relatively high tax cost. In reality, a lot of people are already beyond that zone of income and nothing you can really do about it. And we don't want the tax tail to wag the dog. If you want to spend some money and you have sufficient assets that happen to be in pre-tax accounts, go ahead and spend and just pay the taxes. That's what the money is for. Life is short and it's a nice problem to have. But when there are opportunities to choose from better sources, like maybe spending down cash or selling something in a taxable account, then it's nice to save on taxes when you can. And on the flip side, if there's an opportunity to take some income at a relatively low rate so you can hopefully help yourself out later down the road, then maybe you want to do that. As I've discussed in other videos, you don't necessarily want to follow the conventional wisdom that says hold off on paying taxes as long as possible. Sometimes it does make sense to use those low tax brackets strategically. So to understand how this works, it's helpful to look at what we'll call an effective marginal tax rate. And I want to be sure to tip my hat to Wade Pfau and others for that terminology and for some great research. I did not invent this. And note that we're talking not about marginal rates nor effective rates, but it's actually the two words together, a marginal effective rate. Let's start by looking at basic federal income tax rates. So we're going to remove any preferential income or Social Security income, and we've got a single filer over age 65. So they've got the basic standard deduction of $14,600 plus the $1,950 extra for being over age 65. So they have 0% effective tax rates down there. And that's an example of why it can be helpful to have some money in pre-tax accounts and avoid converting everything to Roth. Again, I've got other videos on that, but then they're into the 10% marginal tax bracket for the next $11,600 of income. And then as their income increases, they move into higher rates. Now, things can get really interesting once we start adding Social Security income or maybe some preferential income like capital gain, long-term capital gains and qualified dividends. So let's say that there is $30,000 of Social Security. Now the graph looks quite a bit different. Here's where you see that so-called tax torpedo. So let's say this person just has their Social Security income. They have not taken any additional money out of their pre-tax retirement accounts, but they want to supplement that Social Security income. So they're going to take withdrawals. That's where most of their money is. And what you can see here in this example, she doesn't even have the 10% rate. She's going to start in, let's say, the 15, pass through the 18 and a half, 22.2. But let's say she really wants about $42,000 of income, and then something comes up. She needs an extra $1,000 for whatever it might be. Where is the best place to take that money? Well, in this example, taking the extra $1,000 from $42,000 to $43,000 has her in an effective marginal rate of about 40.7%. So if she takes out $1,000, she's going to pay an extra $407 in taxes. That's going to come as a surprise if she just glances at the basic tax tables and assumes that she'll be in a much lower tax bracket. Let's quickly look at the capital gains bump zone also. So you might think you're paying little or nothing in taxes on those long-term capital gains, but as you add income at certain levels, you might cause more of those gains to be taxed. And you're otherwise in a fairly low income tax bracket, but the fact that you cause the gains to be taxed results in a higher than expected effective marginal rate on that additional income. So here you might think you're in the 12% bracket and you do a Roth conversion, but you end up having to pay 15% in taxes on some preferential income that was otherwise not taxed, resulting in a higher marginal effective tax rate. So let's check the Dinky Town calculator just to see the Social Security impact in action. Now we've got a single filer over age 65. Their income right now consists of $30,000 of Social Security benefits. You can see that none of it is included in their taxes. And if we go down to what they actually owe in taxes, they don't have to pay anything in federal income taxes at this point. But let's say she takes $41,000 out of a pre-tax IRA. What's that going to do? Well, the actual tax due is going to become $55.41 and 50 cents. And what you'll notice also is that some of the Social Security benefits going to be taxable. Now, to really illustrate that 40% rate, what we're going to do is add an extra $1,000 here. So we've got $42,000 of income, and the tax due becomes $59.4850. So if we take that $59.4850 minus $55.41.5, we get a result of $407 due on the tax. We divide that by $1,000 of income to reach 0.407, which when we convert it to a percentage is 40.7%. We come back over here looking in the Social Security tax torpedo zone. And again, it says that if you did have 41,000 and you added a thousand or two, you would then be in the 40.7% effective marginal rate. So in this case, she might have been better off getting that extra $1,000 from somewhere else if that's all she needed. That's because she happened to be right at a place where the tax rate was pretty high. And, let's say she had some dividends or capital gains. It's possible for the tax to be actually closer to 50%. Let's just say there's $10,000 of preferential income. That can actually bump things up quite a bit in certain ranges. Now the number is different. We're not at 42,000 anymore. The ranges will move. Going back to our baseline, no preferential income. If she was already pulling out, let's say, $50,000 per year from that IRA just to help support her spending, then this doesn't necessarily matter. She's already beyond that point where it's going to affect her, where her next decision or her next $1,000 really matters. But, sometimes you are in a place where this does matter. So that's how these graphs can really be helpful. You can take a look at what you already have. This is something this is income that you can't do anything about, right? So your Social Security, maybe some of that preferential income. And by that, again, we mean the long-term capital gains and qualified dividends. And you could look at what might happen if you add income. And that word add is the key, as this is designed to help you understand what additional income on top of what you already have, what that additional income does along the bottom of the chart. So I cannot overemphasize this. When in doubt, remember the word additional. So how do you use this? You just enter your information. You're going to say whether or not you're single, married, filing jointly, is anybody over age 65. Enter your annual Social Security income, the amount that you will get for the year in question. Enter any preferential income that you have, and then give it a whirl. See what's going to happen, and start looking at the amount of ordinary income you already have. For any retirement planning scenarios, that's typically going to be withdrawals from your pre-tax IRA, 401k, 403b. It might be a pension from an employer, but you're basically going to find that point on the graph. Let's say it happens to be 53,000 here, and look to the right. Well, why don't we make it more interesting and say it's more like 79,000? So you look to the right, and if you see anything that looks funky, then that's where you want to start to pay attention. If you see relatively appealing rates to the right, then that might be an opportunity to convert money to Roth or take additional withdrawals from those pre-tax accounts. But if the rates are going to look less appealing, and especially if it's a dramatically less appealing shift, then again, you want to pay attention, and it signals that you might want to at least explore some alternative ways to come up with the money, and sometimes there's just nothing you can do about it. So give this a try. I'd love to hear if it's actually helpful for you. Now, a few things that are important to know. Number one, this does not tell you everything you need to know. For starters, it's not going to catch every single transition down to the dollar, but it should hopefully highlight the big inflection points and get your attention. So if we look here, we're looking at 87, 88, and then 89. It might not be the case that when you move exactly from 88 to 89, you're at 27%. These are $1,000 increments. So it could be the case that you can stay in the 12% for a while, and then you will eventually be more comfortably in that 27% for a while, especially when you're near one of those inflection points where the chart goes way up or way down. You really need to do the math using Dinky Town or whatever else it might be. That's just the easiest, publicly available resource out there, but you need to do the math. The actual difference might not be as dramatic from point to point, so you want to know those details. A couple of other critical things. Number one, healthcare. This does not account for IRMA. You have to track that separately. So if your income rises above certain levels, you may find that you have to pay more for your Medicare coverage. That is critical to know about, and you can do some strategic planning around that, but this graph does not do that for you. And the same goes for ACA subsidies or Affordable Care Act. As your income rises, your health insurance premiums and other factors may change, so be aware of that. Those aren't necessarily taxes, but they are increased costs that you could face if your income rises, and so you have to plan for that. And you can also convert those increased costs to a percentage basis if you want. That's up to you, but anyway, keep it in mind. This also will not capture income from interest, such as in your bank account. So if you've got money earning 4 or 5% in an individual or joint bank account, for example, that's additional ordinary income. So you need to keep that in mind. And that income might be subject to the net investment income tax. So that's not going to be captured in this tax graph, where it does occasionally show some impact from the net investment income tax. That interest earnings that you get in a bank account or maybe in various other places are not going to be accounted for. Worth mentioning that you might have lots of other types of income, so just be careful. This is just one tool, and you should be using numerous tools to figure all of this out. And even if you do double check with Dinky Town or with your tax preparer, or you put this all into your DIY tax preparation software, for example, those tools and this tool could be wrong, and unexpected and complicated things can happen, so your findings may be wrong. So you're using this at your own risk. It is meant to, again, help point out some signposts that help you figure things out, but then you still need to drill into the details. So I hope you found that helpful. I'd love to hear if you're using this and what kind of results you're getting. And if you found this helpful, check out some of my other videos on planning your retirement income.